Today, we're going to break down one of the most powerful concepts in all of investing, diversification. Let's dive right in. So, let's be real. We all want our money to grow, right? Of course. But what nobody likes is that stomach drop feeling when the market goes on a roller coaster. So, the real question is, how do you get that growth without all the crazy emotional swings? And that question leads us right to what's known as the investor's dilemma. It's that constant tug of war between chasing those big returns and, being terrified of losing it all. I mean, picture this. You put all your savings into one super promising stock. The dream of it skyrocketing is intoxicating. But what if something goes wrong with that one company? Suddenly, all your eggs are in one very fragile basket. The risk is just as massive as the potential reward. That right there is the danger of putting all your chips on one number. But what if there was a better way, a more elegant solution to this whole dilemma? A way to manage that risk without totally giving up on your growth potential? Well, there is, and it's all about the power of the mix. At its heart, diversification is a really simple idea. It's that old saying, don't put all your eggs in one basket. By owning a bunch of different things, the hope is that when a few of your investments are having a rough time, others will be doing great, and it'll all kind of balance out in the end. Okay, so here's where it starts to feel a little like magic. The first huge benefit is pretty obvious. Diversification can seriously smooth out those wild ups and downs in your portfolio. It lowers the volatility. But believe it or not, that's only half the story. And boom, here's the punchline. This is the closest thing you will ever get to a free lunch in the world of finance. It's pretty much the only strategy out there that can lower your risk without automatically forcing you to lower your expected returns. Think about that. You get a much smoother, less stressful ride without giving up on getting to your financial destination. So how on earth does this actually work? Well, it's not magic, it's actually math. Let's pull back the curtain and look at the science of opposites that makes this whole thing possible. The key idea here is a concept called covariance. Now, don't let the technical term scare you off. All it really means is, how do two different investments tend to move? Do they rise and fall together? Or does one tend to zig when the other one zags? This makes it super clear. On the left, if you own two different tech stocks, they'll probably move up and down together. That doesn't really help you diversify. But on the right, what if you pair that tech stock with a company that sells something people always need, like, say, soap or toilet paper? People buy that stuff whether the economy is booming or busting. Those two stocks often move independently of each other, and that is the secret sauce to a stable portfolio. Okay, this all sounds great in theory, but what does this benefit actually look like? Well, we can visualize it with a famous chart that shows us exactly how this works. This brings us to something called the efficient frontier. Now, the single most important thing to notice about it is that it's curved. It's not a straight line. If it were a straight line, you'd just be getting the average risk and return. But that curve means something special is happening. And this is it. This is the whole point. That curved line is the benefit of diversification made visible. It's that free lunch we were talking about. It literally shows you that because you've mixed your assets, you can now get a higher return for the same level of risk or get the same return while taking on way less risk. That's the gain, right there in that beautiful curve. All right, so we've covered the what and the why. Now let's get to the most important part. How can you actually do this? How can you put this amazing idea to work and build your own smart portfolio? The great news is that modern tools like stock screeners make this so much easier than it used to be. First, you can make sure you're getting a good mix of different types of stocks. Some stable value companies mixed with some high potential growth companies. Second, you can easily filter by industry so you're not accidentally all in on tech or healthcare. And finally, you can actually look for assets that tend to zig when others zag to balance out your whole portfolio. In fact, all that super complex math behind the efficient frontier, it can now be pretty much completely automated. There are all sorts of apps and tools that do the heavy lifting for you, helping you find that perfect mix of investments that's tailored specifically to how much risk you're comfortable with. It makes this incredibly powerful strategy accessible to just about everyone. So as you can see, diversification is so much more than a boring buzzword. It's a real, proven strategy for a smarter and, frankly, a less stressful investment journey. So now that you know the what and the why, the only real question left is, what's your first step going to be?